Are we facing another global financial crisis like we saw in 2008? Is it a good time to buy a property? Or is it too late to be selling? And your last question is probably, what are interest rates doing? In this video, I'll discuss all your queries and more. I plan to present my 2024 housing market forecasts. If you clicked on this video, you're probably asking yourself what the hell is going on with the housing market. In this eye-opening video, we will deeply dive into today's housing market issues. Yes, it's reflecting 2008 once again. Using historical patterns and current clues, we're sketching a clear image of the looming hardship. However, this time it's taking a darker turn. Keep watching to discover how this might affect both property owners and investors alike.
This question comes from Tom Seymour. He says the first sentence of a recent Financial Times article read, "Charlie Munger has warned of a brewing storm in the U.S. commercial property market, with American banks full of what he said were bad loans as property prices fall. Please elaborate on what's going on in commercial real estate. How bad will the losses be, and what sectors or geographies look particularly bad?" I'll just add an addendum from another viewer who wrote in and wanted to know if Berkshire would be more active in commercial real estate as a result.
Well, Berkshire's never been very active in commercial real estate. It works better for taxable investors than it does for corporations taxed the way Berkshire is. So I don't anticipate huge effects on Berkshire, but I do think that the hollowing out of the downtowns in the United States and elsewhere in the world is going to be quite significant and quite unpleasant. I think the country will get through it all right, but as they say, it will often involve a different set of owners.
Yeah, and the buildings don't go away, but
the owners do.
The bubble era. A time came when housing prices in the U.S. climbed before a big jump. After 2002, real estate became a hot topic. Like a fresh gold rush, prices rising day by day, making buyers unhappy, puzzled, and angry. You're not the only one. If this experience seems a bit too familiar, mostly, it's clear that this market has seen prices progressively increase after the 2012 crash. However, a significant explosion came following the events of 2020.
that from time to time, even in great localities, you've seen it happen in New York a couple of times, in the last 30 years, where the swing in properties values has just been huge. And what we see in our residential brokerage business, and we're in I don't know how many different states, is we see a slowdown every place. Now, we see it most dramatically in some of what have been the hottest markets. And the markets where you're going to, in my view, you're likely to see the greatest fall off and where you've had the biggest bubble are the ones tend to be the high-end market, and they tend to be ones where people have bought for investment or speculation rather than use. $100,000 for a house and mortgage it for $270,000, and if the value goes to $250,000, if they have a job and everything, they won't move out. I mean, you don't lose a lot of money, even though the market value on a given day is less than the loan value when families stay together and employment is present and all that. But when you have investment type holdings or speculation type holdings, when you in effect have had the day traders, of the internet move into the day trading of condos, then you get a market that can move in a big way. First, it sort of stops.
The new bubble, here and now. Many people realize this market is far from ordinary. It's straightforward. The present bubble is here, this moment. Looking backwards, it appears to be nearing the end phase, a time focused on speculation, investment, and greed. If you're still watching this video up till now, this indicates you're someone who takes financial matters seriously. Kindly hit the subscribe button and subscribe our channel for more amazing contents like this. Warren Buffett's warning, a look back. Before the previous crash, there were plenty of those. warning of the impending disaster for the housing market. It seems there were a substantial number of major investors and average individuals who suspected the market was a massive bubble ready to pop. And guess who was one of them? Warren Buffett, the superstar of investing. He was asked about the residential real estate market in 2006 at the Berkshire annual meeting. It was on the cusp of the previous bubble. Did he think it was another bubble? You're about to witness something remarkably comparable to current happenings across the United States. Not only does Warren highlight the risks, but accurately points out how speculating property investors mix high risk and greed. Just as he predicted, this deadly blend would trigger a breakdown. Take a look.
I also think that some of the sin that was in the manufactured housing finance a few years ago has shifted into the finance of the stick-built houses. There is a lot of ridiculous credit being extended in America in the housing field. And it had a horrible aftermath in the manufactured housing sector, and my guess is there'll be some trouble in the stick-built sector in due course.
Well, dumb lending always has its consequences, and usually on a big scale because you don't see it for quite a while. So therefore, it's like a disease that doesn't manifest itself for, a few weeks, and you can have an epidemic of something like that, and by the time you know you have an epidemic, you're very well into it. Well, that's what happens in dumb financing, and you had that. You periodically get it, but you certainly had it in commercial financing in the 80s, and you had the RTC and the savings and loan crisis and all of that, because literally one dumb project was put up after another. A developer will develop anything he can borrow the money against. It's that simple. And when the lending institutions pour the money out for something, it will get built.
What does Warren emphasize in his response? Investors have transformed the real estate market into a penny stock market, misusing leverage and focusing on flips as if they were day trading on their computers. The danger of speculative investments. If you examine the data, you'll see that investment activities have increased in the past couple of years. Many investors are using secret, unreported speculative fundraising methods, including shady loans. Also, the housing market paints a clear picture of the vital few law, as Warren just stated. Stocks trade in real time from Monday to Friday, offering ongoing value awareness. In contrast, houses are sold based on comps, often resting on a few deals. Perhaps you think your house holds a particular value due to a neighbor selling a similar house at that price months prior. He points out that this method of estimating value is terrible. It can fluctuate dramatically. Just a handful of unsound deals can impact the entire neighborhood's value. This is why housing bubbles could unexpectedly pop. He highlights that investors only need one person to buy into their price. Given the high cost of real estate, the market tends to stay optimistic. A single, uninformed purchase can often bolster a whole neighborhood's economy. The domino effect, how it unfolds. However, when news of a drop gets around, things can move fast. Investors often hurry to leave. We see this in many markets when things start going downhill. For instance, imagine Phoenix in 2007. House costs dropped 5% monthly many times. Say you owned a $300,000 home. In just 30 days, it lost $15,000 in value. Fast forward to 2008's hard times. From March 2008 to 2009, an average property in Phoenix dropped 37% value. This is just an average. Real estate veterans who were there tell of great losses. Some areas suffered much more. Many homes lost 60% of their value in 1 year, devastating the owner. History, repeating itself. This habit of drastic price ups and downs, similar to a bubble, typically ends in a sudden drop. Warren and Munger addressed the same issue at the Berkshire conference I mentioned earlier. They discussed these repetitive lending scenarios and their consistent results. Check out what they had to say. Ultimately, the situation brewing now looks a lot like what happened earlier in the 2000s. Yes, things aren't exactly the same as before, but like the saying goes, history repeats itself. But it often sounds congruent. Risky loans taken by daring folks in many parts of our nation are causing the dramatic price fluctuations we've witnessed lately, and this gigantic peak will eventually collapse harshly. The unpredictable nature of housing crashes. As stated before, the issue with housing crashes is that they don't generally shift smoothly upward or downward. Instead, the market might change rather suddenly. This can lead to great annoyance during an extended tough journey upward. The bigger the improvements, the bigger the possibility that the descent will be just as sharp. Thanks for watching. If it was helpful to you, hit the like and subscribe buttons to share these tips with others. Because, who knows, your simple like may help someone. And don't forget, there's much more to discover on our channel.